Hi, Raymond Hempstead here, Managing Director of Supavest. I'm sitting down with Anthony from Property Investment Store and SDA Management Australia, and we're going to be having a discussion about the intricacies of the NDIS and SDA system across Australia and debunk a whole lot of the myths that are around this process. All right, investing into your self-managed super fund, a big part of that is looking at high cash flow properties. NDIS stands alone in the ability to be able to generate high cash flows and long-term income for your self-managed super fund. But in saying that, one of the things I see a lot of people are out there promoting these huge incomes from SDA housing and NDIS housing. What's some of your thoughts about some of the numbers that are out in the market at the moment and how sustainable are they?
Yeah, good question. And yes, it's a question we often get. Obviously, when you start talking about high income or strong income properties, the greed kicks in. Yeah. Everybody gets excited. There's a lot of comments about income and the level of income that you can get in this NDIS SDA space. I guess we're in a fairly unique position because we have the property investment store side of the business that we design the homes. We work with builders around Australia to build those homes for us, and we actually consult to those builders all the way through the process to get the right product. But those designs and everything we do on that end of the business, that information comes from our SDA Management Australia side of the business, which is our management side. And that's the side I think that is the key part of it, because we know for a fact what the incomes are, and we know for a fact what the real challenges are. Everyone quotes these figures and quotes these wonderful things you can do and get, but the issue with that is that those numbers aren't always right, or they are certainly glossed up to make a sale.
Because a lot of times people go onto the government website and go onto the calculator, put in the specs of the house, and it comes up with this huge number.
Look, you can do all that, but once again, as I like to say to people, communism works in theory, but when you roll it out in society, it's not such a good idea. Yes. Okay? So all these websites and all these things where you can find, but this map shows me in this area there's all these people with disabilities in this area, so it must be a good area to invest in. The problem is in this space is that you, me, nobody controls what goes on. The participants that get approved for the funding, they're the ones that control what goes on. SDA stands for Specialist Disability Accommodation, and that basically means that people that get approved for that level of funding through the NDIS, those people have a significant disability, and they're not in a position usually, in a lot of cases, they can make their own choices in majority of cases, but there's certainly some that can't, and there's family members that help them make these choices. But the fact of the matter is they still get to make choice, and they still have the final say. It doesn't matter how many people that are on the magic list that seems to exist. I want to know absolutely how many people in this area before I buy there. So would I. I'd love a Ferrari for Christmas too, but I put the big stocking out, but nothing came, right? So at the end of the day, we can only go off the facts, and the facts are that yes, there's some statistics and numbers in the background, but none of those things are things you can use as you would normally use in a regular property purchase situation. An NDIS SDA property purchase situation relies very much on a business like ours, which SDA Management Australia, we rely pretty much solely on our relationships with our care providers. And that's what gets us tenants. All right, so we've been here since the start. 2019 we started. Yep. We had no idea about what to do. We were scared to death, and we thought we're going to look like idiots because we know nothing about this space. And then we very quickly realised nobody knew anything about this space.
It's all brand new, 6 years ago.
It was all brand new. And not only that, we thought all the care providers are going to think we're idiots because they're not going to understand, we're not going to sound like we know what we're talking about. They didn't even know what was going on with it. They're so busy looking after participants and caring for people's day-to-day needs, they didn't have time to go and read a 50,000-page document to try and figure out how it all worked. So all we knew in the beginning is that as long as you knew 1% more than anyone else did, we were an expert. And we kept running along that line, and we kept using the idea that if we build really good quality homes in areas that are strong areas, then we've got a good chance of getting a participant because they're going to like that design, that idea. And that's what we were told in the beginning, and we went down that road. And here we are 6 years later, and by default, not by me, having any crazy plans, we're one of the leading SDA management companies in Australia. We're now in a position that we have about a 95% plus occupancy rate on our properties on our books, which means that really is the answer to most people's questions. When they want to ask me about, can you prove give me history of tenancy and what you've found over the last few years, and how quick will I get a tenant in this location, and what are the numbers of people looking for tenants in this area? None of that matters. What matters is what the proof in the pudding is and what we've got in the end result, which is a 95% plus occupancy rate in our homes. So we know we can get tenants for people because we build the right homes in the right locations based on what the management teams have told us to build and do, and that's what we focus on.
And those designs over the last 6 years have actually developed and changed a great deal, haven't they?
A lot. I mean, as of July 1st last year, there was pricing changes under the SDA pricing model for the four different categories of funding that they offer through that. And those changes also came with then elements of design change that we were able to do to certainly attract. We have a very unique structure in what we do, and we were able to basically be able to accommodate any one of the four level of participants in our homes, which is very rare because a lot of people focus on high physical support builds, which is great. You can go and build as many as you want of those, which is everyone their dog's building.
And
them.
with that, I'll stop you there for a minute.
Yeah.
HPS is a big thing people out in the market, and they promote you can have 3 HPS in a house and you'll make $200,000 a year. You make so much money a year, and the marketers are out there flogging this belief to the public. What's the reality of what's actually happening out in the space?
Once again, you can have that theory, but when it plays out in the real world, it doesn't work like that. A lot of these people who are participants who have this funding and approved funding, they want to live on their own. They don't want to live with other people, or they'll get fussy and try to live on their own, or they won't choose a property because they're saying, well, there's 2 people there already, or the chances of having shared accommodation in high physical support is there, but the likelihood is very hard. We don't focus on high physical support because, to be honest, everyone else in Australia is doing that. So we really focus on robust homes, and we get them approved as a robust home. Certainly with a robust home, you will not get a second participant in a robust home to share. It's a very complicated participant level, and it's one that they don't share or play well with each other. And it's one that is in the beginning, we didn't understand it, and we've learnt that, over the years, that is a very tricky space. So we design our homes to be very specific and have design elements around that concept. We do really only 2 designs, which is a house and a dual key design. And we know with the dual key design, we can get 1 robust participant either side, and that will generate very good income. But the numbers that we quote when we do a brochure and show clients, what we're doing, they're not numbers that are just like pulled out of the sky, mythical. These are numbers we've already got with our current property management. So we know we can get it.
You're actually doing those right now.
That's right. We've got them on our books and right now that's exactly what we know we can get. So we're using numbers we know are real. And to be honest, we may even get better than that. Like on a dual key design, if we have a 3x2 bedroom type setup, then on the 2-bedroom side you might get 1 robust participant, but on the 3-bedroom side there's a good chance we might get 2 fully accessible clients that might want to share. And if we do, we get even better funding on that, especially now since the changes in July.
So with that, what's the guarantee that gets talked about in the market? I know you love that word.
Oh, I love that word. Look, I like to say that a lot of people always talk and use the word risk when they talk about NDI. It's too risky, or there's a lot of risk in it. I don't like to use the word risk because a risk is something that can kill you. I like to use the word challenge because there's a lot of challenges in this space, but challenges are things you can overcome. And challenges are certainly prevalent in this space, but they're mainly around the fact that to do with the tenancy and to do with that idea that people are like, well, it all sounds good and there's great returns, but I want even more. I want a guarantee, Well, I mean, there's no guarantees in life. And if you want to use the old saying, which has the unfortunate word in it, risk and return are relative, well, it sort of has that element here, okay? If I understand there's a lot of horror stories in the space why people would be concerned and want some sort of guarantee. And to be honest, anyone that's offering a guarantee, I'd be very wary of their position, because you just can't guarantee tenants in this space. It is their choice where they want to live. So you can't force them to live there, and there's no magic list that you can run off to do that. So I'm just, usually they're underwriting a guarantee, and they might guarantee a lower percentage rate, like an 8% return, when they're probably getting a 12% maybe if they get a tenant, and that's where they're keeping the difference, right? So there's certainly smoke and mirrors going on there. Whereas with us, we just tell it as it is. This is the tenant we believe in this area we can get at this level, right? And we will quote those levels, and they are real numbers. We have got investors who are earning currently 19% return on their investment properties. We know, because we see the numbers, what they bought the property for, and what they're getting in return. Calculator, easy to see, right? So we can see that we actually have got clients earning amazing returns on their properties. But once again, there's no guarantee in this space, and anyone that says there is, I'd be very, very wary of them.
And one of the things I love about your product and your system is I see it a lot of times where there's people that have gone out to a builder, they can build an NDIS house.
Oh yeah, anyone can.
Anybody can build it, they can meet the specifications. Are they meeting the specifications just, or are they meeting them exceed? But they get to the end, and what are some of the figures? I know I've heard some stupid figures like $50,000 and $60,000 or $20,000 to find participants, and the house sits there for a long time empty.
Because we own the management business, daily, and I can't tell you how many times a day sometimes we get calls from investors, and I'll go on to the second people that call us in a second, but the investors often ring us saying, I've had this house for 12 months, they promised me a tenant, I can't get a tenant, can you help me? We don't take on external management, because a number of reasons. Firstly, it's unfair to our investors that are bought through us to be then stealing potential tenants away and giving them to some random person when that investor's dealt with us and come to us. I think that's a very unfair way to approach it.
But also the quality of houses. You control the quality of house that you're actually putting the participants into.
And that's the thing. We don't want also to be bringing on rubbish to then give to our care providers, and they're going to say, hang on, that's not the stuff that you guys normally provide. Why are you giving us this trash? Because I can get this trash anywhere. I came to you because you've got good properties. Because we design our homes to be like a beautiful home, not a hospital home. And the other reason is, to be honest, we want to starve out these dodgy operators that are doing what they're doing and causing all this problem to all these investors. They'll probably build 30 or 40 homes, and then they'll realise all of a sudden they can't get the tenants. Their investors are ringing them every 5 minutes going, well, where's my tenant? What have you done to me? You're killing me here. And then they're going to say, stop, don't build in this space anymore. Now, I had a phone call the other day from a very big builder in Queensland, who is very heavily into the space of building NDIS properties and promoting it and doing all these webinars. It's a big deal for them. They can't find management. They rang us the other day looking for management, and I could hear it in the girl's voice how desperate they were, right? There was a real fear in her voice around the fact that we're really desperately trying to find someone. I said, I thought you had already had someone before. That's why you were doing this. I was, being a bit coy. And they, we did, but it didn't really work out. Well, this is the problem. If you don't run your own management and you rely on other people, they can pull the pin because they get freaked out by how hard it is too, because everyone thinks they can just do it. Or they try and charge, I've heard stories of $60,000 to find a tenant and 21% management fees just to get one participant, because people are so desperate they end up paying it. So, these organisations and people are getting burnt, and they're being put in a really precarious situation with obviously funding and lenders and banks, and having no tenant in there and having to foot the bill themselves. Now rates have gone up, it's costing them even more. And if they do put someone in, it's nowhere near the number they were told.
And I find in any investment you need to be managing your, as you said, risk. It can't kill you, but it's still some of the things you've got to be managing.
That's right.
And a lot of people, they see the big numbers and they think the risk is removed and they don't do their due diligence. No. And part of that due diligence is who's the SDA provider?
That's right.
Who's the management company behind it?
Because that's all that matters. Because all the lists and all the other things that don't really exist, there's lists. You can go on, there's a government website that shows you how many people in your suburb have a disability and what their disability is. It'll actually show you how many people in that suburb have autism, have Down syndrome, have all the levels of disability. And you think, there's like 300 people in this suburb, But there's 300 people with a disability. But how many of them are actually approved for SDA funding? Because that's
What's
the key.
that process?
Well, that process is massive. I mean, that process is very, very. It's doctors and doctors and doctors. It's reports. It's all sorts of stuff.
6 to 12 months, isn't it?
It can be. It depends on the complexity of the participant and then obviously their disability. But and then also it depends on the person at the NDIS, because I've heard some horror stories from the NDIS of people not actually understanding disability at all and making a real joke of it, to be honest, and making it very problematic. Like people with serious disabilities getting rejected because they just don't understand a disability. So the fact that people live in an area with a disability is great, and every suburb in Australia has people with disability. 14% of the Australian population are on the NDIS.
14%.
That's almost 4 million people. But it's only 6% of those people that are going to get approved for SDA funding.
Okay.
So it's a very small amount of people that will actually get this approval. So if you want to keep running down the road and buying properties like the high physical support that everyone and their dog's building, there's only so many people with high physical support that will actually get SDA funding to start with. But then of those, there's only so many people then that there are going to be houses available for, because there's so many houses available. So it's easy to keep thinking that this is an endless supply and the world just keeps producing, this situation, you'll have tenants, but it's not that simple. There's nothing simple about this space.
So what's your philosophy about building houses in certain areas? And you see it all the time, builders come in and build 20, 30 NDIS houses in one estate.
Yeah.
What's your thoughts around that?
Extremely dangerous. I mean, they do it, and when one of these builders particularly owns all the land, so of course they're going to try and sell their own land, and they'll build as many as they possibly can in that estate. That's all very well and good, but the problem is that how many people, once again, in that area have SDA funding for the level of home you're trying to build? You don't really know until you start working with the care providers and those organisations and building those relationships as a management company with a good product that they like, because they hate a lot of the product that's out there, because they just say, it just looks like a hospital.
Yeah.
And then the participant looks at it and goes, I don't want to live here. I've been living in a hospital for the last 8 years. Or somewhere that's like a hospital, because actually some of the participants that we have, I mean, they've been spending all their life in hospital, or they actually keep them and look after them in prison, because especially with robust needs participants, they're very dangerous to other people and themselves. So the safest place to keep them until they get a proper robust home is in prison. It's awful. We had a participant recently who is 56 years of age, and for the first time in his life is living in a house.
56.
He's been in institutions and hospitals all his life. And for the first time in his life, he's moving into one of our robust homes.
Wow.
Right? The stories that we hear and the horror stories we hear, from the treatment and it's like we're living in some third world country, the way people with disabilities are treated. And it's horrible. 6,500 people under the age of 40 living in nursing homes because there's nowhere to put them. One girl was telling us a story that she was mentally, this girl was absolutely there. She was sharp as a tack, right? But her body had failed her. Physically, she was, and that's why she was living in a nursing home. And, she was there for 2.5 years, and she said that all her flatmates, in other words, the old people in the nursing home with her that were leaving her, in other words, dying. Right? And that she loved tennis, and she wasn't even allowed to watch the tennis because bedtime was 8 o'clock every night, whether she liked it or not. Right? The first night she moved into her brand new home, she went out with her friends till 4 o'clock in the morning because she could. Right? It is changing people's lives. It's giving them opportunity. It's making things and transforming things in people's lives, which they never had an opportunity to do. But the problem is, you can't go whacking a bunch of people with disabilities all together in one suburb and building all these homes and just thinking that that's how it's going to work and that you're going to get all these people flocking in there and that's going to work. It doesn't work like that. We have a policy that we basically only will look to put 4 to 5 houses in a suburb. Until we see what that does, and then we may come back to that suburb later if we see that there's a need. And if we've created a buzz there with the local care providers, and they're like, when's your other property going to be built? We'll get stuck into doing a few more there because we know that they want more and there's a need. But until we know that, we're not going to go and crazy and onslaught areas that it just ends up hurting the owners, the investors.
Yeah, because you've got a benefit. You're actually building the house. But you're also then managing them. So if you're not building the right area,
we don't get the management.
Yeah.
People don't get it, right? We're in the lifeboat paddling to that desert island with the owners, with the investors, right? Because at the end of the day, if we build the wrong house in the wrong area, the wrong level, and we don't get a tenant for you, we don't earn any money from the management side of the business. That business is designed to make money, like every business is in the world, right? So we want to make sure we build the right house, the right level, the right area, so we can get a tenant as quickly as we can, so we get paid. So it's a selfish need for us that ends up benefiting the investor.
Exactly.
Right? Because at the end of the day, we're all the same lifeboat. We all want to be paid. We all want to get that journey and be, how good's this? If we can get extra tenants in there because they want to live there, we get more money, you get more money, everyone's happy, right?
It's a win-win.
There's no reason why we're not going to be working our butt off, basically, for the investor to make sure we get them as much money as we possibly can, because that's going to only benefit us.
Yeah.
So it's a win-win for everybody.
It is. So looking at investing and having professionals on your side, from someone with their self-managed super fund, or even outside of self-managed super fund, you can do this as well, short, medium and long-term investments. Having your companies, I'm going to use the word loosely guarantees. It gives the best chance.
We've got guaranteed history, haven't we?
You've got guaranteed history.
That's what you're
You've
looking
got
at.
runs
That's
on the
your
board.
guarantee. Yeah.
Like whenever you look at an investment, what have they done in the past? What's moved them to make them successful now? Are they continuing to do that in the future?
That's right.
And so from an investor's point of view, inside or outside super, this is the best solution.
Well, we believe, and look, we'll too don't own home, because at the end of the day, as I said, I didn't design a business to be the number one business in Australia at what we do. By default, we've basically become that business.
Because you're good at what you do.
Because by default, we've just been doing what we thought was right, and it's worked.
Yeah.
So that's why we're focusing so hard on making sure that we continue to do that.
Because what you're looking at, I've heard the term participant from the eyes and the view of the participant. So what you're actually building is being built from their point of view, not what you think is the best thing.
Everything we do, it's got nothing to do with what you want, I want, the purchasers want, investors want. It's got to do with what the participant wants, what they need, and what level they need it at, where they need it.
And that also comes back to location as well.
That's it.
There's a lot of rhetoric in the industry at the moment about the cost of the NDIS. Is it going to last? Are the government's going to pull it? What's your position, especially with 6,500, like the number of people that are out there still with disabilities? What's the chance the government or any government's going to stop the NDIS?
Look, once again, like everything with these questions, you've got to come back like this, and then explain the history and then come back, right? Okay, let's look at where it started, right? The state governments ran disability, and that's why it ended up like it is. It was just awful. I mean, it's literally third world level disability running. It was just horrible, right? Because the state governments were funding it, and they were always struggling to get money to fund it, and it was always a problem, right? The NDIS as a concept has been overseas for years. Germany, UK have had it for like 30 years. Right? It's been a great system over there. So instead of Australia going over there and going, let's copy what they do, they just went, no, let's just reinvent the wheel. So the government decided in their wisdom, the federal government decided that they would take it on. And they said, well, we'll take this on and we'll run this. So they introduced a 0.5% increase to the Medicare levy, which basically
so
you and me, we all pay for it, right? Which is genius. I mean, they should do it with aged care. Same thing, right? But that's a whole other discussion. That's another discussion. But the 0.5% increase in the Medicare levy raises about $30 billion a year. So that is able to fund close to 4 million people.
We'll highlight it. $30 billion that you and I and all the population are paying going into the government coffers right now.
Extra.
So
it's not costing. This is not coming out of their budget. This is something that they've gone, well, we're going to increase something and get that money from over here.
So are they spending $30 billion right now?
I mean, I've heard...
On NDIS.
Well, let's just say I did hear recently that there's $3 to $6 billion at the moment being fleeced from the NDIS. They're not quite sure if it's 3 or 6. Okay? Mismanagement off the scale, right? They need to get the sort of stuff out internally and figure out what they're doing. My belief is they need an NDIS police force to go around and figure out who's fleecing it. And mate, you're going to jail if you're trying. I mean, if you want to steal money from people with disabilities, you are seriously different.
You're the bottom of the bottom.
You are. So anyway, that's something they've got to sort out. But all I can say is, the answer to that question, I always say, is, okay, based on that history I've just given you, that little history lesson of where it's all come from and where it is now, if they pull it, these 4 million people, who mind you, most of them are voters, what are they going to do with them? Do you reckon the state governments are going to want this back? Ever?
Real life.
Right? This is a federal government problem forevermore. Right? It's not a matter of, this, that, and the other. It's a matter of they've got to make this work. There's no other choice. Because the only other choice is put the 6,500 people back into nursing homes and do things like that. Will they get voted in for doing that?
But even if you look at just at that position, with our ageing population, with our old people going into nursing homes, there's no space for them.
There's no space, but not only that, people with disabilities are living longer. Modern medicine is enabling people with disabilities to live a lot longer now. So the problem is not getting better. We're not fixing this problem. It's only getting worse. There's more people coming on the scheme. And to be honest, if they have to keep raising the Medicare levy to pay for it, I'm not don't have a problem with that, okay? I mean, at the end of the day, I'm sure no one has a problem with paying a little bit of money towards people with disabilities, because guess what? You could have an accident tomorrow and be in that position that you might need some funding yourself.
Yep.
Okay? So we've got to look at it from a perspective of, it's all great to talk about all the, they're going to end it and the money's going to stop and all these things, but what's the alternative? Because it's easy to say if they're going to stop it, but what are they going to do to fix it? Because there's 4 million people with that problem, as I said, 14% of the Australian population. I mean, we're looking after a large sector here, and it can't just happen, overnight to end something that is basically, it's working, albeit slow and a little clunky. The 6 years that I've been in it now, I've seen good changes. There've been positive changes that have gone wrong, and they are figuring it out that they need to support. The most recent change with the pricing increases overall was a smart move. They realised that the build costs have gone up. They realised that the only way to make this work from the SDA point side of view, with investors investing in this sector, was to keep the numbers strong, right? But then the problem is the abuse happens by the builders, and everyone wants to jump on the bandwagon and make it work again, and make some money and buy the desert islands and retire.
Yeah.
But once again, it's a government problem that they're going to have to solve if they were to stop this.
Yeah.
And I don't think that'll ever happen. It has to.
It'd be similar to like taking away Medicare.
If you did that, I mean, Australia would be like a third world country. I mean, one of the things that sets us apart versus all the other countries around the world is we have a wonderful medical system that actually helps support us. And you go even in America and places like that, it's horrible over there for their medical system. You got to get it with your job and be on the system. If you're not, it's horrible. It's a terrible position to be in. It's a third world system. So, I think that the question to answer that back is to everybody, what's the alternative? And there just is none.
Yeah. And I see with the investment, and now a lot of people across Australia, even if they're tight in investing, now this is a bit of a plug for Supavest.
Yeah, cool.
You can actually use your superannuation to build these sort of properties. And so without necessarily affecting your lifestyle that you're living day to day and the bills and the pressures that are on that, you've got access to be able to set up a self-managed super fund and build these high cash flow properties and build your generational wealth in that.
Oh, massively. I mean, I look at this, and the biggest problem we have when we speak to investors is how we're going to minimise the tax implications on the income they're getting. A dual key property that we've got on the, currently on the books, for example, might bring in $150,000 in rent.
It's a big chunk of money.
It's a big chunk of money. Now, you can't really own that in your own, own the property in your own name then, because if you're earning $150,000 a year already in your income and you get $150,000 in rent, you're in big trouble.
There goes half of it.
There goes half of it. So you really need to, consider the idea of things like trust and different ownership vehicles like that are going to minimise it and bring it down to maybe a 30 cents of the dollar tax rate.
Yep.
But that's the best you can do.
Yeah.
I mean, there's really nothing else you can do on the outside of super fund option. But the reason I like, working with you guys, obviously with the product you've got, is that it enables our clients to say, well, if I was in a position to be able to buy my super fund, I'd only be paying 15 cents of the dollar tax, which is just incredible.
And keep all that extra money
And keep all that extra money for your returement later. And it gives people an option that, is just way above what we can ever offer them on the outside of a super fund.
But it also then gives people the option to be able to buy two at once. Where if they've got the capability of building it outside of super, because that income now can be used for your own lifestyle.
That's right.
And supporting you if you want to work less, one of you want to stop working, pay school fees. You've got a lot of choices.
You mentioned the other day, we were just discussing about super funds and the amount of money they've been spending of super fund, people's money that they've been spending on their behalf, and the idea that, well, you're letting them do this. Why are you letting them do this when you could be setting up your own self-managed super fund doing it yourself? So what were some of those numbers? Because they were just horrific.
Yeah, they're huge. Like APRA did an investigation of 12 of the leading industry super funds, and they found that they spent over $80 million in advertising with no discernible benefit back to the members. Now that's
wow.
That's over $80 million of if it's your super fund, it's your money.
Yeah, I mean, that's money could have been invested in making me more money.
Exactly. And then there was another report just in the last couple of weeks through the Sun Herald, where there was nearly $40 million of industry super fund money that were paid across to the unions. So between the two of those, there's in excess of $120 million that have been paid from industry super funds to third parties that had no benefit back to the members. Now, if you have got your money in there, I'm sorry.
Yeah.
But you've got a choice. You can now take that money out of the industry super funds, set up your own self-managed super fund and control your money. Like, it's your money. Who better to actually manage your money than yourself?
That's right. And I always say this to people when they say, where's your super, what's your super fund money doing? They go, oh, well, it's in such and such, whatever the fund they're in. I go, no, that's not the question I asked. What's it doing? Oh, well, they invest it and stuff.
And where is it?
Where is it? Like, where's your money? This is your money you're going to be retiring on. You don't even know where it is. Self-managed super fund, we know where every dollar is. It's under your control, under your management. So why not invest in something that you can benefit from in a big way from growth, a property, that if it's an NDIS property, you can get amazing income as well. And I think we did some numbers, and for most people that buy, it was like $1 million property, if they bought it in the super fund, it was only 7 or 8 years that basically they're going to pay that off and own it outright, which means all that rent coming in then is just building up more money to go and buy another property. So why wouldn't you want to do that? Than leave it with these mongrels that seem to be just blowing it on crazy junkets and whatever they're blowing it on,
Yeah, and people haven't been educated, because up until now you haven't been legally allowed to build in your super fund if you're going to use debt.
That's right.
And that's where Supavest really stands alone, because you can now build a high cash flow property like this. On $1 million property, if you've got $350,000, $400,000 combined in your super fund, and that combined with up to 6 members, you can now own $1 million NDIS property.
Yeah.
And if that's the only one that you do, and in 6 years that gets paid off because of the rental return, you've now guaranteed your income for retirement.
That's right.
If that's the only thing that you do.
That's right. You can just reinvest that income coming back in and just keep buying.
And keep buying.
And just keep buying.
Yeah. But you can now actually have a plan on how you're going to build your super. Yeah. Not a hope that the industry super funds are going to grow, or hope the share market's going to grow, or hope that they're going to pay your dividends at the end of the year, and hope the directors of managing those companies are doing the right. That's all hope. Now this is actually a solid plan. You're building a property. You're literally changing the lives of disabled participants.
That's right. Giving them quality homes.
And also changing your life, because you're now generating that income, that long-term income. So it's very astounding what gets spent. One of the comments people might say to me, oh, it costs money to set up a self-managed super fund. Yeah, it's a once-off fee. And you might spend, I don't know, $2,500 to $3,500 a year in accountancy fees for all the legal side of what you do in lodging back to the ATO. But have you actually looked at how much fees and how many fees you're actually paying against your money right now?
That's right.
And most people don't, because it's all smoke and mirrors and it's hidden.
That's right.
So...
And I've been doing this a long time, 28 years I've been doing property and finance, and I've been sitting with a lot of clients over the years, thousands of clients. And a sad statistic that I see is most 55-year-olds still owe around about a third of the value of their home, no matter where they live. So the issue with that is that they might have a $3 million house, they owe $1 million, or a $900,000 house, they owe $300,000. It's all relative. But the problem with that is they've only got 10 years to retirement. The problem is they're looking at saying, well, I've got 10 years to retirement, I can focus on that, or a $300,000 or $1 million home loan, whatever it is. Which one do I focus on? What have I got to fix before I retire? Either way, if they keep trying the way they're doing it, they're never going to fix the problem.
No.
They're going to be in a world of pain when they retire because they're not going to have enough in super, or they're going to have more in super but still have a mortgage they're going to have to pay out anyway.
Yep.
So, using the super fund to do this sort of stuff is just so powerful on the super fund side. What we can show them on the outside of the super fund, we can do amazing things there too, and we can help fix those problems, normally with their structures. But that's the problem. They've only got a limited time to get to that point where they're going to retire, or they're going to end up working, in their 70s, which unfortunately you see a lot of people still doing.
Yeah, but actually making a decision now, especially in your mid-50s, and if you've got some equity in your home, and you've still got a third of the debt there, unfortunately.
Yeah.
I know I've seen some of the strategy work. You can actually have that paid off by the time they retire.
Yeah, no problem.
And have money coming in.
That's right.
And have a decent retirement.
Have some sort of cash flow.
Have a cash flow.
Options are the key, right? If you don't have options in your life, then you're in big trouble.
Yeah.
And when people say, I've got super, I've got my house, they're not options. You've got to live somewhere, and the super's you're funding for the rest of your life. They're necessities.
Yeah.
Options are 2 or 3 or 4 investment properties or things like that, or shares or other things that you're investing in. They're options. And if you don't have those, you have no real choice. You're going to have either downgrade houses or minimise what you're living off your super, and it's a terrible position to be in.
Yeah, and people talk about they've got their super. The average person in Australia, based on the government statistics, will retire with a couple will retire with 690,000 in their super.
But together.
And that will give them an average retirement, and that'll earn them about $70,000 a year.
It still sounds like a lot more than what I've seen with clients.
No, this is average.
But I'm surprised that's the average, because most
That's
clients
what the
I've seen
government's
are way
promoting.
lower than that.
Oh, my dad retired on the government pension, and he wasn't anywhere close to that.
No.
But that's what people don't understand.
Yeah.
The rhetoric that they've been sold over the number of years.
Yeah.
You get to retirement and it's too late.
Yeah.
They got the choice now to be able to, okay, let's make some moves, let's make some choices. And with the NDIS and what you're doing and managing the whole process, it gives them now that choice to be able to take control back of their lives outside of super to pay off the third debt or pay off their debt, but also inside of super at the same time if they can do it, and actually set up their retirement and actually plan for how much they want to live in retirement.
Yeah. I've had someone recently ask me about a self-managed super fund.
Yep.
What is the minimum balance they can transfer from their existing super fund across to set up a self-managed super fund? Because their accountant or financial planner had spoken to them and said, look, you really shouldn't, we wouldn't do it for anything under $250,000.
Yeah.
And I thought, well, that sounds a little high and a little, is that because of the fees and things like that? Or what comes into that sort of decision-making process about what the amount is that you can swap across?
Yeah, I think part of it comes back to their licensing and what their head licensee has put in place. But that also then comes back to what can they invest that money into? Because there are fees. You're going to be spending $2,500 to $3,500 a year in managing your self-managed super fund through an accountant, lodging your asset reports and doing your audit.
Yeah.
So there are those fees.
Yeah.
Then you look at, okay, how much I'm going to make and pay those, what's left over.
Yeah, so I suppose what ASIC look at that in a sense if they were audited and say, well, hang on, you've just done it to get the fee and you haven't really given them a good enough return.
Yeah, exactly. There's not a return. Is that the best that we can use for that money?
Yeah.
And there's a whole rhetoric about some of the financial planners. Let's be honest, most financial planners, over 80% of them can't talk about property anyway.
No, that's right.
All right, because they get paid as a percentage of fees under management.
That's right.
So it's a bit of a
products and all that sort of
securitized product. So if you've got $200,000 in the share market, they get every year they get their money.
Yep.
They've got 500, same thing. If you lose money, they don't care. They still get their money. But then when it puts into property, and I'm taking this up to 3 years ago before Supavest came around, you couldn't actually leverage that money and build a high cash flow property.
Yes,
so you'd actually have to buy a property, and what you're buying is going to return you 2, 3, maybe 4%.
Yeah, so the whole negative geared mentality.
Yeah,
that sort of
exactly.
Yeah.
So that then, they're right. By the time you pay your fees, you're actually losing money, you're not making money.
But now you've got a position where you've got positive cash flow properties.
Exactly.
And especially with NDIS structures and things like that, which we can bring in, all of a sudden, these numbers are huge.
That's
the opportunity is huge. So what you're saying is that that you could look at someone that has less money now because you can justify easily in a sense that what you're looking at to invest them in is something that's going to get them a higher return.
Exactly, and it comes back to their investment strategy. How are they going to build their wealth in their superannuation fund to support them in retirement?
Yes.
Now you've got products like Safe Property, where you can get up to an 11% return on a $65,000 or $60,000 investment. Yep. And so someone with a lower balance can now invest that money,
That's right.
get up to an 11% return, and also capital growth against the property.
Yep.
Now, from an investment side, an investment strategy side, where can they get better than that?
That's right.
Out in the share market.
That's right. Very hard.
And so
Yeah.
when you're now talking to your financial advisors and they can play in the property space and they now know about these products,
Yeah.
it will change the levels that people are setting up their super funds for, because now they can actually make more money
Yeah.
on lower balances than what they can out of the industry
sense.
super funds.
Makes sense.
Yeah. So it'll change the way, if you're talking to your accountant, if you're talking to your financial advisor and they said, oh, you need 200,000 or 250,000, they more than likely don't know what we're talking about here today.
No.
They don't know that you can build high cash flow properties, you can get into a safe property under tenants in common where you can make an 11% return, plus the capital growth on the property. And so as an investment strategy, that will change their mind, because once they see the numbers talk. So yeah.
Stop for a sec. We'll keep talking, but I want to start on safe property stuff. Oh, she's been holding that.
Well held.
We'll keep it going. Whenever you guys are ready.
So I've been in this industry a long time, 28 years. I know I don't look it.
I know, you look young.
I do, you know. It's aged me, they believe me, internally. In the time I've been in this industry, you know, I've seen a lot of things, good and bad. And as I always say, I've always learnt my best lessons from all the bad things I've seen, because you just think, well, that's what not to do.
Yeah.
But I must say that, you know, when we've been chatting about the new product that Supavest has sort of now, you know, brought out, in a sense, a new product, Safe Property. When we started chatting about that and going through that, and the more that we've done that now, it's pretty much blown my mind. I just think in the last 28 years of me being in this industry, there's never been a product. When I speak to people and they say, what do you do? I say, I'm involved in, you know, showing people investment property, how to invest in property. I always, you know, from 80% of people, I get that,
They can't do it.
because they know they're not really in a position, right? And we're really only dealing with the tip of the iceberg people, the people that are poking out of the top of the water, and they're that sort of 15, 20% of the population that can afford to buy an investment property, okay? And, you know, I love making people, you know, be able to make money and be better off in life. That's a great thing.
Yeah.
But certainly the idea that 80% of the market are that iceberg under the water, they can't do anything, or so they think. And the idea of safe property is now an option and an opportunity for them to do something that I've never seen be able to do in this industry the whole time I've been doing it. So can you give us, in a nutshell, version of safe property and what it is and why you brought it into the market and why, you know, we both believe it's a great product?
Yeah. All right. Originally, where it came from is we were selling land and house packages under a single part contract in Supavest to investors in their self-managed super fund, and they were ending up with $80,000, $120,000 cash left over, and it wasn't enough to get into the next property. And so they're putting it back into their bank accounts and getting paid.
Sitting on it.
They're sitting on it.
Yeah.
And when I looked at it, it's like, okay, there's got to be a better way. So then I started, you're looking at shares, share market. On my bias, by the way, I've got a bias against shares, I've got a bias in new properties. Just put that out there.
Full disclosure.
Full disclosure. And you should get that from anybody you get advice from as well. What are their biases?
Yeah. You can live in a property, but you can't live in a share. That's my belief.
That's it, you can. I like that. Then I looked at it and said, okay, these high cash flow properties, they are amazing properties. But you need a good chunk of money to get into them.
And that's the NDIS SDA properties that we've discussed. I mean, obviously great returns, you know, obviously challenges there, which, you know, we can go into that later. But the idea is that there are opportunities now with properties that get really good incomes. And once again, if you buy them in good areas, can get really good growth.
That's it, but they're limited to that 15, 20% of
well,
people.
probably just limited to the top ones are probably the 2 or 3%, because really we're talking now that sort of property that's going to get maybe a potentially 13, 14% return, say, is going to be over $1 million.
Yeah.
It's going to be in a really good area. The way banks work with that NDIS SDA product as well, they're not very friendly with it.
Yeah.
It's a painful product for everyone, you know, in the journey to usually get into. But as I said, it's that really top echelon of people that can get in.
So I recognise that, and I wanted to open that market up to the people that would sold properties to, so they could buy a part of it.
Yeah.
And so we set up
A little bit of a good property.
a little bit of a good property. So that's where it came from. So we're under a tenants in common. Now, tenants in common is basically you own a 5% or 10%, or you own a percentage of the share and have the same rights as if you own the whole property, right? But you control that small amount. And so I came up with that idea, and we started providing that product to people in self-managed super funds. Then I stepped back and looked at it and thinking, hang on, now this opens up the entire market to the average mum and dad that have got $60,000, $70,000 sitting in their bank account. They're trying to save.
Massively.
Now they can actually own a 5% share of a high cash flow property, like an NDIS property.
Yeah.
And take part as if they're a high level investor.
Right, so top shelf and bottom shelf prices, basically.
100%.
Yeah.
And so now opening up the entire market to everybody, even if they've got only a small balance, and they can now build over a period of time where some people that we're talking to have never owned a property.
I know.
Never.
I mean, look, I've seen over the years, the reason why I'm excited about the product is because of what you just said. There's so many people that are in the position where, I mean, I'll see young guys, they've worked their backsides off as an apprentice or something, and they've got up 4 o'clock every morning, and they've not gone out every weekend with their mates to save up 80 grand.
Yeah.
You know, and then they're coming to me going, I've saved me 80 grand, what can we do? And I go,
Nothing.
nothing. Mate, 80 grand these days just doesn't buy enough. You know, it doesn't, and if we do, it's going to be some horrible dog box somewhere that I'm just putting them in to make a commission, and I'm not going to do that, right? I would say to them, listen, you need more money to get into something that's going to be worthwhile, that's going to get you some growth and going to get you on the journey. So often we get sort of hamstrung with those people, and there's nothing I can do with them. Mum and dads who want to invest for their kids, I think always, you know, oh, we're doing this for the kids. Well, I always say to them, well, you're not. You're doing it for yourself, like the oxygen mask in the aeroplane, you know? I mean, when they fall down, you put it on first and put it on the kids later, right? Same with property investing when you've got kids. But this is an opportunity where they can do both. They can go and buy an investment property. Often we'll see clients who said with a little bit of leftover money, they might have 3 kids, that we can say, well, let's get $60,000 for each child. Let's put 3 different 5% shares in 3 different properties, and let's now sit that there for the next 15 years. And the kids and the kids are making money on the growth over that 15 years. But the beauty is the rental income that's coming in from that is paying that loan
So it
amount.
costs them nothing.
It costs them nothing to do it, to set their kids up in 15 years' time.
Yeah.
So, you know, but then obviously there's other clients with super. So explain the super side of it, because I mean, I think there'd be massive opportunity in that too.
Oh, likewise. Like there's some people that have got low balances and can't get into the NDIS high cash flow properties. So they can now buy 5, 10, 15, 20% shares in these NDIS properties and own and get the rental return from those.
Yeah.
But they're also picking up the capital growth of the property.
Yeah.
So whether it's inside or outside super, like if you're saving money hoping to get into the market and it takes you 5 years, the property market's gone up.
Oh. You're never going to save as fast as the market.
You can't save as fast.
It's just the capitalisation, you know, of the property. You can't.
So once you get your first $60,000 and you buy into the market, now you're
on the train.
You're on the train.
That's it.
Like,
you're on the journey. You might only be that much in the train, but you're on there. The foot's in the door.
Both feet are on the floor.
That's it.
You're moving.
That's it.
And so as you're saving, your appreciation on the property is going up. Your rental income's coming in, and we talk about up to 11%.
Yep.
That's an amazing return.
It is.
And it gets paid back to you monthly.
That's right.
So if it's in your super fund, it's building your super fund every month. If it's in your personal name, it's building your bank account every month. Now there's taxing implications, you've got to look at those.
Yeah, but super funds are awesome because, I mean,
15%.
If you've paid cash for that out of your super fund and that money's coming back in, that cash is just building up and up and up. I mean, you could just go and buy another share again in a couple of years, couldn't you?
Yeah,
and exactly. Just keep doing it. There's no reason you couldn't keep doing it if you wanted to.
And we've got some clients now with their financial advisors, and that's their strategy. They'll end up with 14 or 15 safe property investments, and they'll own 5% shares of 14 or 15 different houses
Couldn't get
around
more
Australia.
diversification in property.
That's
if they tried.
diversified. That's diversified.
That is.
And that will end up, they'll end up with $1.5, nearly $2 million worth of property by the time they retire, and they'll be on $150,000 worth of cash flow income.
That's right.
Now, if you just look at that strategy, compare that to what the industry super funds are saying that you'll end up in retirement on, and it's just chalk and cheese. But you actually now set, again, you've actually set a plan of how you're controlling it. And it's controlled against Australian property.
And you own, because you own Tenants in Common, you own the share, you're on title,
own it.
You're part of it. So let's say, and I know the answer, but for the people at home, let's say I've got a property share in one of these properties, my 5%, 10 years time or 5 years time, whatever it might be. I've just said, rightio, I've made enough money that I want to pull that money out, because I can't borrow back against it. It's only cash sitting there that I've put in. I can't get a loan against it under the rules. So that's okay. I want to now sell my share. What do I do?
We've got first right of refusal because Safe Property owns the 65% of the shares, so we only ever release 35% to the market. So we'll have first right of refusal. We'll get two independent valuers, they'll value it, and we'll take the average of the two, and that'll be the purchase price. But now what you've got an asset that's gone up in value, that's got a track record of monthly income coming in every month.
That's right.
And you can show the next investor coming in,
that's right,
this is what it's earning me. Here's the rental statement.
That's it. And if Safe Property doesn't take it up, that's where Property Investment Store will actually say, right, you've got first right, you've said no, for whatever reason you've said no. If you do, I mean, the likelihood you're probably going to say yes is probably pretty strong in most times. But generally, if you said no, Property Investment Store, we will then be able to sell that to one of our own investors who wants to get on a journey on a property that is existing and that is showing a track record. And there's a lot of clients out there that want that because 100%. They want instant return on the property they can buy. They don't want to wait for something to be built. There's a lot of advantages in that. So that's the key part about that. So I mean, it's effectively a liquidable asset because people get
semi-liquid. Semi-liquid
compared to obviously shares are way easier to liquidate, but regular property in a lot of ways would be, I think, harder because you've got people with a lot more investment from someone to purchase in. Whereas a 5% share, even if it's all relative, it's going to have gone up, but someone buying at that point, it's still cheap to them at that point in time.
It is, and one of the other questions I get is, what happens if the other shareholders don't want me to sell? No, it's got nothing to do with them. Under Tenants in Common, you control your 5% share or 10% share. You can do whatever you like.
That's right. And if you decide to sell your 65% share, anyone can decide to buy that as well. We can sell it the same way. Someone can say, well, I'm going to buy the 65% share.
Yeah, exactly. So it's your money, it's your share. If you do a search on the property, your name is on the Land Titles Office. It comes up.
And that's the biggest thing about this product versus many others, because most of those are very smoke and mirror orientated with all the unit trusts and different weird setups and charging you fees and different things. And the reason we partnered together was mainly because we believe we've got a great product that can achieve these numbers and achieve these results in real terms. I think there's a lot of other companies out there with NDIS products that definitely can quote all the numbers, but whether or not they can achieve it, that's the bit that's a tricky bit. But because we own the Property Investment Store that designs and work with the builders to build these homes, then we own SDA Management Australia that runs the management, looks after the management of these properties. We currently have a 95% occupancy rate, and we know what we're doing on the management side because we work with relationships and all these providers that we work with to be able to get the tenants. We know these numbers are real from a management point of view to what we can achieve. That's why we believe the two products had a great synergy between us, because you had the structure, but we've got the product that we can join together and create a really well-structured product that's actually going to achieve the results we want to achieve for people. And we're not trying to gloss the numbers up. We're trying to be realistic about what we're saying. Once again, if we don't get a tenant in that property, then we don't get paid. So it's up to us to get a tenant and make sure we get a tenant. We want to keep the structure as simple as we can and have the ability for people to invest in this and to further their financial situation. Even from a small amount of money, they can develop into quite a large sum of money in no time.
Very much.
Because growth and rental income.
Exactly, and that's where Safe Property opens up that whole market, and it will change the way accountants and financial planners are building their wealth strategies for their clients, because this product now opens up rental or the real estate market in high cash flow NDIS properties where they can get small chunks of it and own it and be able to manage those returns. So yeah, it's going to literally change the market and how people are investing.
It does, because for me, I see it all the time. We can get someone at the bottom end, but they're going to struggle, and I'm not going to get them a great. I'm a big believer in cash flow positive property.
Yeah.
Cash flow is king. When you buy an investment property, it's like you're buying a small business. And if you don't have the cash flow, you're not going to survive.
No,
and you're going to go backwards, and it doesn't help you funding and moving forward to do other things. And that extra bit of money coming in is going to help you, be able to keep leveraging yourself into more units in different properties and 5% shares if you want to. And as you said, if you want to keep building up that mentality where you take 14 or 15, 5% shares in 14 or 15 different properties, it's not a bad way to diversify.
Yeah, and also outside of the financial side, it also comes back to a psychological side.
Yeah.
As an individual, when you actually become a property owner, it changes your outlook on life.
Does. Changes every day you go to work. You're not going to work for just pay the bills anymore.
No.
You're going to work because you own a property.
Yeah.
I wonder if people would say they own 14 properties if they own 14 shares.
They could.
Could you get away with it? I guess you could.
100%.
So why not?
Like if you think about it, if you own half of something, that half is actually a whole.
That's right.
So you actually own a whole property. That might be 5% of it.
Yeah, but you're still owner of that property. It's like buying in a unit complex, isn't it? There's 50 units in the block. You own one. Yeah. You own your little bit of ground and dirt, and you own your unit.
You are a property owner.
It's the same thing.
Yeah.
And that's the beauty of it.
Oh, just psychologically, outside of financially is fantastic, but psychologically,
it's huge.
Like in talking to some of the people over the last couple of months that have never owned a property.
Oh yeah.
And seeing the lights come on in their eyes, it is now possible to actually own a property and get into the property market as an investor. Where this is going to go and how we're going to be changing people's lives over the next number of years is amazing.
Now, look, I'm excited about it, and I think that being able to partner with you on this project is great. And what we're able to bring together is our two sort of businesses and our ethics and approach to this, which is that we both want to see people empowered and people kicking goals in this sector. So I'm very excited.
No, me too. Last thing, what would your advice be to the people that are looking to invest into NDIS properties, either inside or outside super, and I'd suggest you do both, if they're starting right now, and where would they go, what should they do?
Well, I guess the first thing with the space is there's a lot of people in the space that have a lot of stories. And I think that I always say to them that I wouldn't believe anyone telling you anything unless they own their own property management business. Because we do, and because we do, we know how hard it is. We know how tricky it is. They all don't really get it unless they're like what we're doing. And I think the issue out there is that not a lot, I don't know how many, I haven't looked, but I certainly would say there's not many of these companies out there who are offering it for sale, who run their own property management business and then also run it as successfully as we do. We never strive to be anything major in the industry, in the sector.
Yet you are.
Yeah, we are, because we just did it right. And we did it the right way, and we looked after people and built the right houses, right areas, right levels, and made sure we were looking after participants and building beautiful homes, forever homes for these people with disabilities that have come from sometimes horrific history of living circumstances now to be able to live into a beautiful home for the rest of their life if they want to. So I think the main thing when you're starting is, look for that. Look for a company that does have what we have. I'm not trying to, talk ourselves up, because I believe we are doing it the right way, and I believe that they should be dealing with us. But I think if you're going to start in this space, in this sector, and looking, stop looking at all the data and the information. You're going to confuse the daylights out of yourself. Everyone wants to dive deep into it, but you just go down rabbit hole after rabbit hole, and it ends up just becoming, you just freeze yourself out from doing it.
Paralysis by analysis.
That's right. So you just can't do it. But I think that we have the history. We've got 6 years now in this sector to show you data and results from us. As I said, 95% occupancy rate in our homes. That's the number I use with anyone when they want to argue about anything. I just say, we have the proof. What we're doing is right, because we've got the tenants. So that's all that matters.
And how long does it take to get tenants?
Yeah, that's the best question.
That's another question. Does it matter?
Look, we don't get paid until we get you a tenant. Right? We start, when we build a brand new home, we start from when the slab's laid. That's when we start looking for a tenant. It can take up to 6 to 7 months. But I've seen my team achieve results that is out of this world with getting tenants. I will never use a number or a time frame because every area is different. Every type of house we're building is different. It's not a sector that you can just pigeonhole.
You're dealing with people.
You're dealing with people with disabilities who get to make their own choices.
Yeah.
So you can't control any of that. So there's a lot of moving parts in this. There's a lot of people involved in the process.
Yeah.
It's not just one person making a decision whether they want to live there or not. There's normally a team of people that are involved with that person to see if they can live there or not, in a lot of cases.
Yeah.
So I think that plays a big part to it. And that, if you're looking to invest in an SDA space, which we do with Safe Property is the number one vehicle to make this work and make the numbers work, it has to be, in an area which we can choose. We get to choose between us, you and me, like what we're going to build and actually offer to our Safe Property investors, where we're putting it to market, what the option for rentals in that area is, because we honestly get to choose the pick of the bunch, because we are bringing on what we believe is the most likelihood areas to get tenants in the most likelihood to get incredible growth in these areas too. So we're trying to bring on this in the Safe Property realm as being the best option we can. So that's a big plus for anyone buying a 5%. They're getting the absolute bee's knees that we can find at any one time in Australia. The world's our oyster in Australia. We've got properties in Western Australia, New South Wales, Queensland. We've got properties all over the place.
Yeah.
We can offer this, and it's a very
And more and more are coming.
and more coming all the time. Yeah.
No, excellent.
Yeah.
It's been amazing.
Yeah, thanks for that. I appreciate just a bit of insight into the Safe Property stuff, and it's been it's awesome to know, and hopefully everyone can learn a bit about what we're doing.
So guys, reach out to the Property Investment Store if you're serious about NDIS investing. All right, you need to have an SDA provider at the start that's got track record. There's so many people out there. I hear it every day. I'm qualifying for SDA. I'm going to become an SDA. Why? Because of the money.
Yeah.
They don't understand what they're talking about.
No.
I've been in Uber cars and they're becoming an SDA provider. I've been with small builders and they're now becoming an SDA provider because of the money.
Yep.
It's not about the money. It's much, much bigger than that.
Yep.
Right? You need the history. You need the relationships. You need 6 years worth of being in the industry to know
Which has
where
only been going for 6 years.
and it's only been going since 6 years. All right. So you need to have an SDA business that's attached to the deal at the start. Now, a lot of builders say, they work with SDA providers, and as Anthony said, there's some big builders that have been saying that, and all of a sudden, those people aren't around anymore.
That's right.
The SDA providers, because they've gone elsewhere. If the people that are marketing the product aren't involved in the building and setting up and design of the product, what real choice and what real guarantee have you got that at the end, the SDA provider is going to be there and supporting you with your investment? And that's what Property Investment Store and their business brings to the table, that whole package. And that's why I'm excited to be able to shoot this webinar and this video, to be able to educate you about what you should be looking for in your investments inside and outside of super. Have a great afternoon. Have a great day. Keep on winning. Ciao.